Let's close with our chart of the week. Viewers, listeners, if you'd like us to break down a chart that you're interested in, please shoot it over to podcast@opalinvest.com and the team will break it down. This week's chart looks at stock splits and their ability to help beat the markets. Take a look at the chart on the screen. It looks at the price returns of stocks during different regimes where they had announced at least a 2-for-1 stock split. You can see during the 1980s, during falling inflation, stock companies that split their stock went up. Same with the strong economy of the 1990s, the bubbles bursting in the 2000s, and the liquidity-driven markets that we've had since 2010. Since the early 1980s, you see almost 100% outperformance from companies that announce stock splits. So the question is, do stock splits matter? Before I turn that question over to the team, take a look at this chart of an ETF. This is TOFR that was liquidated in 2017, and they were trying to capitalize on this thesis. For 3 years, they ran an equally weighted ETF that only invested in companies that had gone through at least a 2-for-1 stock split. Austin, what's your take on stock splits and investing?
Well, based on every finance class that I've ever been in, stock splits are meaningless for the actual share price. But based on what we see in markets where there's a lot of, let's say, retail money chasing trends, stock splits can be a significant driver. This just goes to show how markets aren't necessarily as efficient as many finance professors would like you to think. Emotion can drive stock prices in the short term, and this is what we're seeing in this construct. You see emotions driving stock prices as people get all excited about stock splits and lower stock prices.
Adam?
Yeah, I think this data is an excellent example of the concept of a spurious correlation, because I don't think the stock split in and of itself does anything, but it could be indicative of management confidence in their next few years. It can result in moving a share price into the right target zone to perhaps get added to an index like the Dow, which can bring in some buying power. There's the psychological effect of an investor with $1,000 to invest in the market doesn't want one share of NVIDIA, but if they can buy 100, maybe they will. So those all point to things that could help a stock price. None of them about the fundamental performance of the company per se, but indicative of perhaps confidence, management's confidence in the company going forward. So it's an indicator, but in and of itself, it's completely meaningless.
You wonder if there isn't some factor research on this. Like, do companies that announce stock splits, do they have above average market earnings growth? And that leads them to the stock split. So it's kind of a cause and effect type situation.
Well, here's a great example. Buffett never split Berkshire stock, and it got up to 36,000, whatever the A shares are now. But when he needed a stock with a lower price to execute a transaction, he created the B shares, which is essentially a split in a way, because it allowed investors to own Berkshire at a more reasonable price. And indicated confidence in the company.
Well, almost any platform today offers fractional shares if investors actually want them. If they want a dollar cost average in, they don't have enough to actually buy a whole share. You can typically buy a fraction of a share, whether you're at Fidelity or Schwab or one of the other platforms. So I don't necessarily see there being a huge kind of benefit to the split, other than there might be some projecting from management saying, hey, we think there's great opportunity ahead, so we want to split the shares. Or it could be an indication that it could be a momentum play to speak to the factor argument, Jay, because if a stock is up so much that it needs to be split, it indicates that it's been moving positively for some time. So the split might just be building on some of that momentum. I'm not really sure. It'd be interesting to see what some of the academics would say about this research. I would say whatever they do say, though, take it with a grain of salt, because they're likely solving for some outcome that supports their argument.
And those fractional shares are relatively new, right? That only happened after stock prices got rid of the fractions and went to sort of a decimal, sort of more precise pricing mechanism. So it'd be very interesting to see this split data over the next 10 years and to see if that outperformance is as strong when people can, in their Robinhood account, they can buy 1/10,000th of a Berkshire share or something, or point
Yeah,
1.2 or whatever
remember
it would
that
be.
Buffett was essentially forced into creating the B shares
Yes.
because there were, people who were out there trying to profit off of the fact that he had a $18,000 share price, and he didn't like that. So he created, instead of splitting it because he was kind of known so well for refusing to split the shares, he created a B share class that essentially looks and acts the same but doesn't have the same voting power as the A shares. And I mean, I guess the thesis behind why he doesn't want to split the shares is because he feels people that have enough money and are long-term invested shouldn't necessarily care what the price is. It also kind of drives home his point that it's less about what the stock is doing and more about what the business is doing, which we agree with. However, we don't all have the luxury of having a Berkshire Hathaway to manage. So it's kind of speaking out of both sides of the mouth there.
And that's actually a great point for the individual investor. Because I don't know about you, Austin, but the number of times I've had someone come up to me and say, "Hey, I'm thinking of buying this stock ABC. The price was 12 and now it's 5, so it must be cheap." And I have to explain to them that doesn't mean that. That just means the price has come down. We have no idea what's gone on with earnings or anything else. The stock price is not in and of itself an indication of the value of the company. So be careful. But a lot of the average person out there sees that and perhaps gets excited on a stock split because now it's 20 and it used to be 100. What a great time to get in. And in fact, nothing has changed.
Well, what percentage of the people, Adam, that actually invest or speculate in the stock market do you think actually know how to value a company? Like go into Excel and actually figure out how to determine what the value of the underlying company is rather than just looking at a chart and trying to understand or trying to guess where the stock price is going to go.
Yeah, no, that's a great point. I think very few.
And it also makes me think about the late 90s when America Online decided to start splitting stocks on a fairly regular basis. And then there was FOMO, because what other companies then started coming out and announcing stock splits to help keep driving up those stock prices? Could NVIDIA be leading the charge on this? Are we going to see more of it going forward? That probably has no rational reason to do it, Austin, to your point. But are they going to need to do it to keep up?
Listen, I think that the rational reason at this point would be to get included in the Dow if anyone still follows the Dow, because there are a number of tech shares that have been running for a long time that are in the kind of high hundreds to low thousands that likely won't get included in the Dow because it's price weighted if they don't cut or if they don't split the shares. That being said, this is an argument that's kind of probably been around since the beginning of the stock market, and it probably gets a lot of play between the kind of the people who follow technicals and charts versus the people that follow underlying fundamentals, because this is probably the biggest battleground between the two, because the pure fundamentalist doesn't care about the stock price. They only care about the market cap and what the underlying fundamentals are doing. And the pure chartist doesn't care about the fundamentals. They just want to see what that squiggly line is telling them on the stock price.